So, good afternoon. I gather you've had a really long week, and now you've got to listen to Japanese equities. I'm not sure that's how you want to finish this week. When I saw where we were on the schedule today, I was thinking about the Israeli parole board study. Do you guys know that? You know it well. Basically, there was a 10-year study in Israel of people that were incarcerated, and they came up for parole. And they did a study of whether people were sent home or back to prison, and they correlated it to when they were heard during the day. And I can tell you that 2:30 p.m. is a time when you're definitely going back to prison. So we're in the dead zone right now. So I'll try and, make this interesting for you. As you've just heard, I co-head our Asia-Pacific equity investment business along with Dave Parrott. Dave and I started our careers actually here at Prudential / M&G in the 90s. I obviously started when I was 10 years old with my 27 years of experience. In 97, Dave started in 92. He's traveling, so he can't join us today. We've spent our whole careers investing in Asia and in Japan. We've both lived in the region for 15 years. Today I'll talk about Japanese equities. I've got some Asian performance numbers I'll share with you, but really going to talk about Japanese equities, the equity asset class in Japan, and why we're pretty optimistic about the kind of long-term risk-reward opportunity in Japan in the context of a global portfolio. Before we jump into that, maybe I'll say a little bit about the team. 20 people on this slide. I'm not going to go through all of their bios, obviously. They're all really impressive people. They're all tenacious, curious, team players. We've got 11 full-time investors, either portfolio managers or analysts. They're obviously supported by the broader infrastructure here at M&G, the central analyst team, the private equity team, the credit team. So there's a lot more than just the 20, but full-time dedication to APAC, to Japan and Asia. We've got 11 full-time investors. There's 5 people that are dedicated to trading and execution. That's a really important part, actually, of our risk program. I'm happy to elaborate on that further in a question. We've got 1 executive in residence, which I think is unusual for a public equity platform. You'd normally hear private equity investors talking about having executives in residence. That is this gentleman here, Professor Yanagi. He is our consultant, if you will. I'll bring him up later on. Again, I think he's a fairly differentiated part of what we do in Japan, especially when it comes to engagement. 2 investment directors, I think they're both at the back, George and Sunny, help us to communicate effectively with our clients. And then we've got an ESG/sustainability coordinator to make sure that what we're doing on the ground with our investments and our engagements really does dovetail very nicely with the broader resource of sustainability at M&G. So a few observations. There's a massive amount of experience in this team. There's a lot of shared working history, which is really important when you're trying to build highly effective investment teams. And then we have a Pan-Asian approach. So I'll just elaborate on those 3 things. Having a lot of experience doesn't really necessarily logically mean anything. I think the only thing you can definitely say when you have a lot of experience is that you've messed a lot of things up and made a lot of mistakes. What you'd hope is that those mistakes are made in the context of a team that is emotionally honest and self-reflective and learns from those lessons, which I'd say that we are. I sort of hate it. When I was younger, I'd hate it when fund managers would stand up and say, we've got a lot of experience. I used to say, who cares? And now here I am, right? But actually, there is a lot. There's a lot of people there with 25, 30 plus years of experience. There's not a lot of that going around. And then we've got it in the context of a shared working history. A lot of these characters have worked together for a very long period of time. Still don't like each other, but you can't win them all. The important thing about the shared working history is that we know how to work effectively together as a team. It's definitely a team effort. And as we know from, there's whatever corny sporting analogy you want to pick out of the air, you can't just put talented people in a room together and expect special things to happen. Managing a team, orchestrating a team, choreographing their movements on a field or at a set of desks is not straightforward. And I'd like to think that we have created a kind of, through time and motion studies and evolution over time, a set of behaviours and protocols and ways in which we work together that generate consistent results. We all know our role on the field, so to speak. And then the last point, we have a Pan-Asian approach. This was by intention. In the early 2000s, you can see different colour codes here for where people are based. We've got some in London, India, Japan, obviously, Hong Kong, Singapore. What I found in the early 2000s when I was pretty much focused exclusively on Japan is I kept having to do research and due diligence on Taiwanese companies or Korean companies in order that I could better assess, quantify, qualify, price the risk around Japanese securities. And then so what happened organically over time is that we built out a pan-regional research process. Now from that, I get to draw from that, and I manage the Japan funds, and Dave manages the Asian funds. But we've ended up building something that I think is, in the end, slightly differentiated, which is we have real depth across the whole region. You know, I think when there are other teams that would, and they're not here to defend themselves, so I can say what I like. There are teams out there that would claim to be pan-regional, but I think what you really see is a Japan guy who dabbles in Asia, or you see an Asia guy who dabbles in Japan. We've got real depth across the region, and that's super helpful. Having Deepika in India, who's looked at the auto sector there for 15 years, is really useful for me in Japan, because Honda's the world's biggest motorbike maker, and India happens to be its biggest market. Same for Suzuki, and so on and so on. So all of those linkages, we've been connecting those dots now for 20 plus years. I think we do that relatively well. So that's perhaps enough about the team. Let's talk a little bit about, we haven't got enough time to talk about process and philosophy, because I can't seem to squeeze it into anything less than 3 hours. And there's not many takers for that presentation, as you can imagine. But what Sunny has put together for me is like a cheat sheet, which is, okay, what can you expect? And what can you definitely not expect? And I think it's probably a better way to get through the material. Let's start with what you should not expect with our team, frankly, whether you're investing in Japan or Asia. We're not macro investors. I don't forecast inflation. I'll talk about it, but you'll never find it. Any of the views that I have about macro are casual. You know, you won't see the risk in the portfolio being driven around what I think Japanese inflation will do or what the yen will do. We have no edge when it comes to forecasting pretty much anything, but certainly not macro variables. Ambulance chasing thematics. You know, we don't. This is a bit naughty of me. It's a straw man, so bear with me. We do have a thematic investment strategy at M&G, but you know, I don't read The Economist magazine and think, oh, you know, solar's quite interesting. Let's go and find some ways to play on that. Or hydrogen's interesting. We're not thematically led. Now, we're not ignorant as to what's going on in the world. AI is a big thematic. We spend a lot of time researching it and thinking about it, but I don't go and find ways to play different themes. So we're not ambulance chasing around that. Forecast-driven decision-making. So we price risk. I think the secret to superior return generation is that you price risk and you don't forecast the future. If some people are better at forecasting the future, then good for them. We've not figured out how to do it. So you won't hear us say, we're investing in this company because we think EPS is going to be 400 per share and the consensus is 300, therefore it's a buy. We might have views that the consensus earnings expectations are logically inconsistent, and we might have an earnings-based view on that basis, but it's not because my model of the future is better than anyone else's. And then what you definitely won't hear us talk about is being benchmark ignorant. This is a little bit of a hobby horse of mine, so I'll try and keep it brief, but I think that I hear a lot of nonsense from the long-only community about active share and benchmark agnosticism. And I think if your client gives you capital and says, I want you to generate absolute returns and cash as my benchmark, or here's my absolute return hurdle, then fine. But my clients, at least, want me to deliver the Japanese equity risk premium and a bit more on top, which I can get from non-correlated stock picking. In that world, it would be crazy for me to be ignorant of my benchmark, to not own SoftBank, even though I have no view when it's an 80-volt stock and it trades at half of its NAV. And even, yes, it's run by a slightly crazy guy, but every now and again he does something very brilliant and the stock can triple in a year. So, you know, I think that given that my differential return versus the benchmark is a function of what I do own and what I don't own, as a risk manager, my job is to focus on both. What do I own? What do I not own? And where do I want to concentrate my intended bets? So we are not ignorant about the benchmark. It's important in Japan because I think that benchmark, as we'll talk about in a minute, is going to give you double-digit returns for many, many years to come. So I definitely don't want to be falling behind that. So what can you expect? I think in that lovely introduction, there was mention of being style agnostic. That is true. I think if we've got a magnetic twitch on the investment compass, it would be to value, because I care about margin of safety, because the numbers are in. We get things wrong a lot. So we need margin of safety. It's the only way you can defend yourself from making mistakes, is to have margin of safety on an ex-ante basis. But we're not growth investors. We're not value investors per se. We're valuation conscious. We try to build a portfolio where the risk and the return will be driven by esoteric, company-specific stock risk. What I don't want to do is to say, sorry, we had a tough year, value underperformed, or we had a great year because growth outperformed, or whatever it is. I'm just not really interested in having that conversation. I think it's odd, because I don't actually know if there's a framework that exists to forecast equilibrium returns for a factor. Never seen it. Maybe I'm wrong, but I don't think there's a financial journal that says that the future return of growth or value equals X plus Y divided by 2 to the power of mumble. There is no framework. There's just oxygen thievery that goes on when it comes to whether value is going to outperform growth in the next period of time. Strong focus on pricing of risk and portfolio construction. This is definitely what you can expect. That's my point about we try to price risk, not forecast the future. We're trying to find mispricings of risk where we have earned the right to a differentiated perspective about that risk. Long tenured Pan-Asian research program. Bunch of old guys, basically, guys and girls. That's what you've already seen that slide. And then this is very important, the engagement-oriented, value-added shareholdership program that we have. This is relevant across the whole region, but it's particularly poignant for Japan at the moment, just because there's so much change going on in Japan. The behaviour of corporates is transforming itself, and that means that the value of voting capital is going from, I don't know, something around 0 or negative to something normally positive. So our ability to have a voice with companies means that there is a window of opportunity for us to actually participate in the value creation of the companies that we invest in. That has never been the case in my career until probably started to get traction about 4 to 5 years ago, and now it's really accelerating. So we've been working on this engagement program, well, actually since 2005. We've been refining it and refining it. I know engagement's a buzzword these days, but we've been doing it for quite a long time. And I mentioned before our executive in residence, Yanagi-san. So he was previously CFO of Eisai Pharmaceuticals in Japan. He was the top-ranked CFO for any industry, any sector in Japan for 10 years. He's written 15, maybe 20 books now on sustainability, on financial accounting, on economic value added. He advises the Tokyo Stock Exchange. He teaches a finance degree to help grow a new generation of CFOs in Japan. And he is our vice chairman. So he helps us choreograph our engagements. When we're invested in companies where we think they could maybe be a better version of themselves by doing A, B, C, D, he works with us to make sure that that message is delivered in a way that maximizes the probability of them actually changing. And we've got some examples that we'll talk about. So that's just a little bit about what not to expect and what to expect. At the risk of breaking protocol, I might pause there and see if there's any questions. Otherwise, I'll press on. Okay. A little bit about returns. So Japan on the left, and then I've got the Asian stuff that I co-manage with Dave, but he's the lead fund manager. So 1 year, and then our tenure, which was Q4 of 2019. So last year in Japan, benchmarks up at 18.5. We're up a couple of hundred bips over that, which actually I'd like to do more than that over time, but it's not. It's been a particular environment. Maybe we don't have time for that. We can get it in Q&A, but that's a decent performance. Certainly, it's hundreds of basis points again above the average competitor. And then since we took over the funds, there's maybe 470 basis points annualized outperformance with a pretty modest tracking error, frankly, in Japan. Asia's had a great year, actually. Last year is sort of getting up for 19% return. These are all US dollar-based returns. Benchmark 12, so it's been a strong year. And then about 400 bips-ish annualized, in the last 4.5, nearly five years. So solid on the performance side. Most interestingly, given what I just said about being agnostic as to style and trying to deliver results that come from esoteric risk, what means as much, if not more to me, is the quality of these returns across both funds, which is they're driven by esoteric risk. When you do the breakdown, how much of this came from sector, from style, very little. Like the dominant driver of risk, ex ante and ex post, has been company-specific mispricing opportunities, which is obviously what we're trying to deliver. So I think both quantity is fine and the quality is good. Let's get to the Japan bit, so I can really get you to sleep. We've got a red thing there. That might wake you up. Look at that. It's like a bullet. So I think that can't forecast the future, but I'm just going to tell you what Japanese equities are going to deliver for you over the next decade. Okay. Let me choose my words carefully. I think there's a very plausible base case that you get double-digit, maybe mid-teen returns from Japan in the next decade. And I'm not trying to be too precise around that. Decade means many, many years to come, 7, 10. Let's be realistic in our inability to forecast anything. And why do I think that? Where is that return going to come from? I think it's going to come primarily from earnings. So in the last decade, Japanese earnings have compounded, depending on which quarter to which quarter, 9, 10-ish% compound return for a decade. That's actually better than the S&P 500. It's pretty impressive, and we don't have NVIDIA. So if I'd have said this 10 years ago, there would have been a huge leap of faith that you'd have to take. I would be saying, well, there's this guy called Abe, and there's this thing called Abenomics, and I think he's going to change the social contract. And you'd say, yeah, maybe not. Well, we're a decade on now, and we can say, well, he did, factually, and the results are in. They just grew earnings an awful lot. So the leap that I would ask you to take is a bit different. It's not, will this happen? It's, will it happen again? Will it happen again in the next 10 years? And I think that there's good reasons. Who knows, right? I have no idea. I think I'm trying to talk in this sort of what's plausible or what's probable. The drivers of that profit growth have not even nearly exhausted themselves. It's not come from strong GDP growth. It's not come from inflation. In fact, it's come in a pretty weak macro environment, if we're honest, in Japan. It's come from margin improvement and self-betterment, self-help. And I think that there is a ton more scope for that. We could go through loads of slides to show you all the low-hanging fruit that's still left in the corporate sector in Japan. So for me, I think saying 8, 10% compound for earnings feels not aggressive at all. I was just in Japan last week, watching all these new midterm plans come out at the stimulation of the president of the Tokyo Stock Exchange, companies looking to compound EPS, now I'm talking, between 7 and 20%. Now, not all of them will, some of them will underachieve, some will overachieve, but we're talking about a corporate sector that was flat on its back for a long time, and now it's talking about driving really strong rates of earnings growth, partly through actions to make themselves more competitive, but a lot of it is just about them becoming more efficient. So if you believe in that earnings story, which I think is very plausible, then actually you're kind of 2/3 or more of the way there. So we've got a reasonable dividend yield today, which is based on low payout ratios, so it's sustainable and can go up. Dividends in the last decade have grown well above the earnings because of that payout ratio aspect. So I think you can add another 100 basis points to compound returns from the dividends, and then the market's buying 2 to 3% of itself back each year. So you can, before we even talk about Japan's cheap and it'll get re-rated, I think you could be into 13, 14, 15% compound return with no valuation increase. And I think we know that on enterprise value metrics, the market continues to be cheap. I'm just bored about saying Japan's cheap, and people are bored of hearing it. So on top of that, you've got a pretty inefficient market. So I think on top of that beta, I think there's a good, for those with a mousetrap oriented towards stock picking, agnostic as to style risk, there is not a bad environment for adding some extra alpha on top of that beta. Here's a sort of slide which actually some of you may have seen before. This is sort of the why now bit. Why not 6 quarters ago when the market was a third lower? This just really charts the scale of the change in the institutional framework within which companies operate in Japan in the last 10 years. You know, I think some people were a bit skeptical about, you know, Arbonomics and the third arrow and all that stuff that we heard over a decade ago. But since then, some people have gotten sort of restructuring fatigue when they hear about Japanese equities. But just quietly, over a decade, we've seen massive state-coordinated change in the framework within which companies operate. I won't read them all off. You can kind of see them there. But this has been no small undertaking. This is the Taxman, the Companies Act. This is proxy advisors, the stock exchange. This is the Cabinet Office, all coming together to say we've got to get the right carrots and sticks in place to make sure that companies are thinking about return on invested capital. So I think if there's any, you know, lingering skepticism about are they going to do it this time, I would hope to eliminate that. I think the facts are in and the framework has changed. Is it too late is a question we've been asked recently, because it has been a good sort of, you know, 6 quarters in Japan. In local currency terms, market's up about 50%, maybe half that in US dollar terms. I don't sense euphoria about Japanese equities. I don't feel like people have been rushing in because they fear like they're missing out. So, you know, those behavioural hallmarks that you might associate with some excessive behaviour, I don't see. I think the market was excessively cheap, you know, 6 quarters ago versus the prevailing facts at the time. But just to, you know, as a cross-reference, looking across the world, these are last 12 months. These are trailing PE ratios, total cap-weighted average median. You know, obviously, you know the difference between all those things. Japan's in line with its long-term average. The PE obviously doesn't adjust for the massive amounts of under-monetized assets on the balance sheet. So I think that looks fine to me versus the globe and versus its own history. It certainly looks good versus the S&P. This box here is interesting. It's even more interesting for the US. There's just literally nothing that's particularly cheap prima facie in the US left. For the rest of global equities, there is. So, you know, half of global indices, including Japan, has still got PE of 15 or less on trailing earnings. 10-year profit growth, 7.6. This is for Topics 100. These are the biggest companies. It's a bit higher when you go down the market cap. Look at the interesting about the US, 7% compound earnings growth for 10 years in the US. If you take out the top 5, it goes to 4. So the best corporate athlete in the world, you know, it's not been growing earnings that much on a net profit basis. So for me, and then concentration, that box right at the top, this needs updating because obviously Nvidia's up about 100% in the last 2 days. So, you know, the concentration's gotten even more extreme. But what you have in Japan is you've got a market that doesn't stand out as being particularly expensive. There's plenty of cheap stuff in intra-market, and you've got compound earnings growth story, both historic and forward-looking, that's well spread across sectors and companies. It's not just about 5 exceptional companies. Wanted to mention, how are we doing? Is everyone still awake? We got the, okay. Wanted to talk about just 2 examples. One's a small cap, one's a large cap, because I like to leave people with the impression that actually the change that we're talking about goes from the very biggest companies right down to the very small. And so I'm going to talk about two stocks. One's worked really well, and I think will continue to work well. One has not worked that well yet, but I think it will work well. So all this change that we're talking about, how does it manifest itself in actual investment opportunities? And you'll definitely hear a lot about, if you speak to any other Japanese fund managers or strategists, you'll hear a lot about this balance sheet stuff. There's a lot of under-monetized things sitting around, strewn all over corporate balance sheets in Japan. And we look at that stuff, and it's important in our margin of safety analysis and so on. But actually, it's pretty easy to find, right? It's pretty easy to, if you've got 20 minutes and and rudimentary skills on Microsoft Excel, and you've got access to Bloomberg, you can find companies that have got lazy working capital, too much net cash, and have a suspiciously large amount of real estate, which normally means they've got a head office that is worth half of their market cap and whatever. I just don't think going after those things is in and of itself that difficult. And it's a one-time sugar hit. Sell your head office, do a share buyback. Okay, great. Then what? Well, then I'm still the crap company that I always was. The really exciting stuff, and so the balance sheet stuff is exciting, but the real juice, I think, in Japan is where you find companies that, as well as having value on their balance sheet, have got value in this is a strange expression, but they have value on their income statement, which is to say, if they change their commercial strategy, they could earn a lot more money. So here's one example. This is the one that's worked well. I'll leave you with the realistic one that's work in progress. Sanrio owns Hello Kitty. Okay, so we invested about here. I love these charts, they're just so good. We've got some that look the reverse, actually. We'll do a separate presentation on this. But so we invested when this was about $1 billion. Why did we invest? Didn't screen as being interesting at all, wasn't cheap on price to book, didn't have really any earnings, so it wasn't cheap on earnings. What changed was that the 93-year-old founder stepped down, and at that time, 32-year-old CEO took over. So that's young in any country. It's definitely young in Japan. And we were interested because it was cheap on one metric, which was potential. So Hello Kitty alone, and they own Mr. Men and 35 other characters, Hello Kitty alone has sold more merchandise revenue in its life, so since the 70s, than Mickey Mouse. I mean, it's right up there with Frozen. How could that sit in a billion-dollar company? This makes net cash balance sheet. Makes no sense. Well, it's because it wasn't really being run very well. And so when we sit down with the new 32-year-old CEO and ask him what he thinks the problem has been, he said, we've been putting Hello Kitty on pencil cases and hair slides and not TikTok. At which point I said, just please hold. I need to go and phone my broker to buy some stock. But more sensibly, we had a conversation with him about how can we help you? As an investor, we've got some really good relationships with other very successful managers of IP. Can we make some connections? Can we be helpful? We make a presentation about some of the things they might want to do, including getting him a kind of full-time consultant, because at 32, he might know about TikTok, but probably doesn't know that much about running a company. He agreed to that. So anyway, did lots of things with the help of our executive in residence, Yanagi-san, and the company's now generating record profits. It's been, it's up 5x or so from when we invested, and I think it can double again and still be quite cheap. But you don't screen that on DataStream or Bloomberg. The data points, that potential bit is part of our mousetrap. That lives with us, having spoken to the company for 15 years or so and understanding how the chart before this, by the way, is like Val d'Isère. It just went down in a straight line for 10 years, sales, profits, share price going down. So part of, I think, the value of the team is we can definitely do balance sheet analysis and find out where we've got some latent assets, but we know where there's hidden potential. And with the engagement program, we're able, in some cases, not all, to work with companies to actually create our own catalyst. So that was a pretty small company, $1 billion when we invested. 7-Eleven's big, $35 billion plus market cap. 7-Eleven is interesting for a number of reasons. We've covered it for a long period of time, watched the company through successful years and tough years. And just over 3 years ago, it made a very big and I think quite bold and aggressive acquisition of Speedway in the United States. And it was $20 billion. And so people were, the whole kind of Rockefeller Center stories came out, another example of a Japanese company losing its mind and losing discipline about valuation and blowing itself up with an overseas acquisition. Actually, the facts were quite far from that, the US CEO, who gets paid more than $20 million a year, which is unbelievable for a Japanese company, which is probably his market rate in fairness. I should have gone into convenience stores rather than fund management, obviously. But he had been compounding that US business at a rate of growth of about 20% for 10 years. So actually, he's a killer. He's a brilliant operator. And they backed him to make this very large acquisition, which was a disposal from Marathon Oil. And so, yes, it was big, but they could afford it. They didn't blow the balance sheet up. And anyway, fast forward 3 years, and I think the domestic investment community still don't really know what to make of this. They're still sort of rubbing their hands a bit about the debt that's on the balance sheet, even though versus EBITDA it's quite modest. But since then, they've extracted $1 billion of synergies. So already it looks like it wasn't a mistake. What they also did was, so the convenience store industry in Japan looks like this. It's 50% 7-Eleven. Then there's 3 other companies, and then there's like 5 mom and pops left. It's totally concentrated. That's store count basis. On a revenue basis, it's 60% 7-Eleven, and on a net profit pie basis, it's 75%. They killed everyone. This is an amazingly well-run business. Now, why are they interested in the US? Because the market's 3 times bigger, and it looks like Japan in 1985. It's totally fragmented. So the number 2 player's got a 5% market share. They used to have 5. This deal took them to 9. Number 3's got 2, and then you've just got an ocean of mums and pops. So they are now by far and away the biggest, which I think makes them the buyer of choice in the consolidation of this industry. They're going to repeat the playbook that they executed exquisitely in Japan, in the US. So now we've got a Japan-listed company that makes 60% of its profits in the United States with a very plausible long-term growth track ahead of it, with a CEO with a great track record, trading on 11.5 times cash earnings. If you take the name off of this income statement, you'd be hard pushed to say, is it Starbucks or is it 7-Eleven? Totally mispriced in a global context. What have we been doing to help them? Why has it been cheap? I think part of the cheapness is this concern and anxiety about this big acquisition in the US, which I think the market should start moving past that now because the facts are in. It's also had a conglomerate discount because, like all Japanese companies, it had the legacy bits and pieces that was going on in the past. The market wanted them to divest that, and it attracted the attention of Value Act, which is an activist fund, and they told them to bugger off. That didn't please the market either. And then they've had a few other issues with their domestic business and some governance concerns. So we went in there, sent our executive and residents in to help us choreograph our engagements sensitively. And in just over a year, they have announced, it's taken us about a year of cautious engagement, and we've basically achieved what Value Act didn't achieve, which is they've announced that they're going to split the role of chairman and chief executive. They've got an independent foreigner in this case, as it happens to be, unheard of for this company, is going to be the new chairman. We've got a majority independent board now. They are going to IPO off their legacy businesses in Japan. So you're going to be left with this global leading retail franchise managed according to global best practice on that highly discounted valuation. So again, here I think is a really good example of a business that is sort of hiding in plain sight, really, just structurally at the wrong valuation, growing, well managed, and in the process of getting rid of all the issues that prevented people historically from wanting to own it.